Should we start with the oil market? Why are there such big concerns over supplies at the moment?
Sure. So look, when it comes to what OPEC Plus is doing, if we just take a snapshot of what it looked like at the end of last year, everyone was thinking that OPEC Plus and their supply increases will be a negative driver for oil prices. But what we're seeing now is that OPEC's ability to meet their production increases is really being challenged. And, amongst the OPEC members, Nigeria, Angola, Malaysia are the key countries where we're seeing production not being met. But now, even amongst outside of OPEC, Russia in particular, there are growing concerns that they may not be able to meet their supply obligations in the first half of this year. So this has gone from a negative driver on prices to now becoming a positive driver as people are now expecting disappointing supply growth from OPEC+.
Not to mention that we continue to see the tensions over Ukraine, right? And the gas markets also really feeling the pain from those tensions. We have heard now that the Biden administration and European allies are trying to look for some supplies elsewhere. What are your expectations of where this crisis will go, especially with energy-starved Europe really having to find supplies?
Sure. So look, it's quite a challenging part of the market when you talk about gas markets, particularly in Europe. Like right now, when we talk about how important is Russia to solving Europe's gas problem, for us that's key. Nord Stream 2 is going to be the solution which will bring that gas supply into equilibrium again. So if we do see gas targeted at any sanctions, it is going to be a much longer energy deficit situation with Europe. And that's something that we expect. And a solution elsewhere, if you look at, say, LNG supply, there is a possible scenario here where we could see LNG supply diverted to Europe. Keep in mind that Europe is the last resort for LNG exports. And what we're seeing out of China is a milder winter forming. So, there is a potential avenue here for flows to move in that direction. But certainly we would think that the most sustainable solution is Nord Stream 2.
Vivek, just getting back to the oil price, as it pushes higher, and we've seen some predictions that it might get to $100 per barrel, what does this mean for US shale drillers? Is there an opportunity here?
Absolutely. And we actually think there's an upside risk when it comes to what the U.S. Energy Information Administration is looking at when it comes to U.S. oil supply. They don't see U.S. oil production reaching pre-pandemic highs even by the end of 2023. We see an opportunity there for U.S. oil supply to expand much faster, particularly if we start seeing shareholders come to the table and agree that, look, we should look at more production increases as opposed to shareholder return. That is certainly something that we think is a positive risk. And in the second half of this year, that could be one of the key reasons why oil prices moderate.
Give us a sense also of how tight inventories are at the moment, and is there an opportunity for the US to tap its strategic reserve again?
Sure. So look, the global oil stockpiles were meant to bottom in January. This has been the expectation from major research houses. And what we're seeing is that doesn't actually seem to be the case if we continue with the current dynamic. And so, if we do see oil stockpiles linger at low levels, that really does mean that this global oil market is very much prone to shocks, particularly if we talk about spare capacity being quite low. So this situation with the potential for strategic oil stockpile release, not just by the US, but even, say, other major oil consumers, it's a very temporary solution. They can only do so much. What we need is something that is going to be effective month after month after month. And in our view, there's only two real ways that can happen. One is a sustainable increase in US oil production. And number two is if we see progress on the US-Iran front and Iranian barrels get delivered to the market.
Vivek, and of course, we continue to watch the metal space as well, right, when you talk about supply, but also because we're just about to get started with the Beijing Olympics. And when that happens, of course, pollution is an issue with these international events. Steel production could be curtailed. What does that mean for the iron ore market?
Sure. So look, when it comes to iron ore prices, that has been one market that has been on fire recently. It bottomed in this last cycle at about $87 a ton on November 18. Since then, it's up about 60 to 65% to just over $140 a ton. Now, this has certainly surpassed any expectations so far. And even our forecast, we actually thought in the first quarter we'd see steel production restrictions really weigh on prices. But what has happened is because of the surprise rate cut that we saw from Chinese policymakers earlier this year and the expectation of of infrastructure investment, we're seeing steel demand hopes start picking up. Steel, when we talk about infrastructure, that accounts for about 30% of China's steel demand. So this steel demand hope is really been a pivotal driver of iron ore prices in 2022 so far. Now, when we talk about these restrictions which are coming, it is going to be notable, particularly in North China. And for us, that's going to be key in bringing down steel output and iron ore prices. But there are still upside risks to keep in mind. And one of the key ones, in our view, is what happens with speculative buying. We already saw China's National Development and Reform Commission come out and say that the reason why prices are as high as they are right now is because of speculation. And they're talking about not just speculative buyers, but hoarders and those who spread misinformation. So we think there's going to be a crackdown here, and that's going to be negative for prices post this Lunar New Year holiday period. But the other key risk to keep in mind, and this is now a key upside risk, is what happens when Western Australia opens up its borders. Because what we've seen flagged, and BHP has said this, is expect disruptions to supply in the first half of this year as we see a COVID-19 spread. And that is something that is going to be very critical. Keep in mind that Australia accounts for about 60% of China's iron ore supply.